Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me this afternoon, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey, Wright, as well as Sal Bruno, Investment Strategist at Nasdaq Global Indexes. We're here to discuss asset class rankings as U.S. equities regain the top spot. It is great to see the both of you, as always. Welcome back to Trade Talks. And Chuck, just like the market, we saw a quick round trip in terms of where U.S. equities went with its rankings.
Yeah, we really did. I think the last time we talked was probably back in April. Looking back was right around the bottom. At that point, the asset class ranking for U.S. equities kind of briefly dipped to number two, given that, we had a 20% pullback in the market, but it quickly rebounded. Obviously, as the market did, looking at the last 3 months. This rally that we've had off the bottom has really been historic. It's basically the best 3 month return that we've had in the S&P since the move off the COVID lows in 2020. And before that, you got to go back to 2009, kind of off the 2008, 2009 bottom. So it's a very historic rally, and really, looking back in time when we see this happen, typically it's off of a kind of a bear market low that you see this kind of rally off a bottom. But here obviously we're not. We're kind of in the middle of a bull, when this happened. There's one other kind of proxy for this market going back in time. That's 1998. You kind of had a similar type of thing happen where it was actually almost exactly the same amount of correction, about 20%, followed by an incredible rally afterwards. If you never know if past is like the present, then and that parallel stays in play, then maybe we get another 20% up, from here before things start to top. That'd take the S&P up to around 7,500, which I think is could happen, right? I think a lot of people are still kind of worried about this market, and the market likes to climb a wall of worry. So I think it is possible that we get there.
Yeah. So let's get your fundamental take on here because despite the headlines and, digesting this news through a fire hose, you're seeing quite favorable conditions for equities.
Yeah, quite a bit. And I echo a lot of what Chuck has said. What we've seen on the Nasdaq 100, it was up 6.3% in June alone, up now more than 9% year to date, and has reclaimed all the value that was lost from hitting its all-time high on February 19th, obviously through April 8th, when President Trump first put on the tariffs on April 2nd, they kind of reversed them or at least put them on pause on April 8th. And that was really the start of this rally and took us all the way kind of back up, making new all-time highs. And in fact, it's been remarkable. So the Nasdaq 100 hit three new all-time highs in June, and it's been a total of eight. I'm sorry, it hit three all-time highs in July alone. And since retaking the top, it's hit 8 out of the last 16 days. It looks on pace for another one. So over 50% of the last 17 days, and counting today, of new all-time highs. So very strong momentum, obviously, in U.S. equities. A lot of the recovery we have seen in the second quarter has been driven by the mega cap techs. They got hit pretty hard, although there was some good dispersion between, if you look at the mega cap names. At one point, the range, if you look at the top 10 companies in the NASDAQ 100, the range of year-to-date performance was 70 percentage points, which is insane. It was Netflix basically up 40 to 45%, and Apple down 20 to 25% at one point year to date. So, and that range is still pretty wide. It's about 60% right now between the two. So we do see some dispersion between the top and the low, even within the mega caps, but it's really been the second quarter mega caps driving the recovery. A lot of it's been NVIDIA. A lot of it has been, we think, kind of settling some of the tariff issues with some of the trade agreements that have been put in place. Some of the others that have been pushed out a little bit to the beginning of August. We still have that out there. And then the market really looking through a lot of the other worrisome pieces, whether it be the conflict in Iran, whether it be tariffs, finally getting the big beautiful bill passed, which some think could be actually kind of expansionary for the economy and good for the market. And so the market's been looking through a lot of that and focusing a lot more on the AI trade and NVIDIA. And we just saw Taiwan Semi just come out and kind of reiterate, in fact, even accelerate that discussion of where AI may be going. So a lot of positives going on right now in the equity market.
Sal, I wonder if some of that dispersion exists because resources were allocated elsewhere within the Nasdaq 100. I took a look at it, and semiconductors and cybersecurity names outperformed the index overall. So, because of the headlines that we contended with in the first half of the year, it would make sense to see that outperformance moving to cybersecurity as more AI is being embraced. And of course, you need semiconductors to power that, right? NVIDIA being one of them. But there are a
Well,
number of other names that fill that category.
yeah, I think that's a good point. But the way we also think about it too is there's been a bit of a dichotomy between goods and services, given where the tariffs are. And so a company like Apple that's very much involved in producing obviously iPhones and iPads and things of that sort, they source a lot and manufacture a lot in China. They sell a lot into China. So they were hit particularly hard on both their sourcing as well as their client base on the tariffs. A company like Netflix is services driven that has really been unaffected by at least the first order effect of the tariffs. It doesn't directly impact them. Now, you can say if inflation goes up and consumers have less money to spend, maybe they start cutting back on their subscriptions. We have not seen that yet. In fact, Netflix is reporting earnings this afternoon, so we'll get a better feel for where they're at and where they're looking for the rest of the year. But I think some of it has definitely been the goods versus services argument, in addition to kind of the continued strength in AI.
And Chuck, it's interesting because your factor work certainly complements what Sal is saying with momentum having led the way this year. But I want to go back to small caps for a moment. They just have not been able to continue any sort of movement off the starting line.
Yeah, they really haven't. Looking at the S&P or NDX, like Sal was talking about, they've all, hit all-time highs. And really, small caps is one of the last kind of big places in the market that hasn't. I think that they really need a lot more clarity on the tariff picture, and really where the tariff picture will then give clarity on the Fed, right? Because these small caps are much more sensitive to interest rates, given that a lot of their debt is floating rate. So yeah, I think they're looking for some more clarity there before people really start to invest there again. But I also think there's this kind of weird situation where, and this is maybe more of me speculating than anything, but I just remember in the first Trump administration, they had tariffs then too. But I think it came out that there was something like 200,000 exceptions to them. And you got to figure that kind of thing's playing out right now, and probably more with the large cap companies than small cap companies, right? They have more lobbying power to be able to try to get those exceptions, and so I think that's just another thorn in the side for small cap that they just don't have the political clout to lobby for those kind of exceptions, and I think that will help them if these tariffs do have teeth going forward.
Let's
Yeah,
talk
and
about.
Chuck, to that
Oh, I'm sorry.
point,
Go ahead.
yeah, I was just going to say a great example would be NVIDIA, right? In the first
Yeah.
quarter, they had to write down about 5 billion of the H20 chips that they were blocked from exporting to China. Jensen Huang has a meeting with President Trump that gets lifted. They are now able to export many of those chips out. So, you talk about the carve outs and then some of the biggest company in the world has a little bit
Yep.
more political clout to get some of their product moved.
Yeah.
Exactly.
It's a great point that you bring up, Sal. Let's talk about international equities for a moment here, Chuck. They're at number 2 in the asset class rankings. You and I have discussed this before, where we saw the outperformance with international equities essentially since the start of the year. So it's not necessarily specific to the perceived chaos that we saw in the first half of the year in the US. I mean, people were looking for value in the beginning of the year, even before we had these tariff conversations.
Yeah, absolutely. Even before the kind of crash in U.S. equities, and which also hit international, we were seeing a lot of outperformance in the international space. I think they were maybe down at number 3 in the rankings at the time. Have come up to number 2 here. And really, even though the U.S. is obviously done phenomenally well off the bottom, what's maybe less reported is that really international is keeping pace. I feel like a lot of times what happens is, when U.S. really gets going, international kind of lags behind to a certain degree. But that hasn't been the case off the bottom. They've had, almost the exact same return. And so that's been good to see. I kind of feel like we're in this phase where, when the eventual cool down happens, right? We're kind of in a white hot period for, say, U.S. returns at the moment. When that starts to cool down some, I think we'll really start to see whether this international trend has legs. Because we've seen this before, like basically going back to 2008 even. We'll have these little pockets of international outperformance, and they never seem to last. And so, yeah, I think, getting through this period will be interesting to see. I mean, I feel like a lot of this outperformance too, and also comes from the falling dollar. It's been basically a dog all year. And, that helps international companies. And so, that's the type of thing. Does that trend stay in place? I don't see, any strong trend or counter trend rally coming yet in the dollar. And so, if that can keep moving down, I mean, that definitely gives it a tailwind. So definitely something to watch out for.
Right.
Yeah,
And
and I'd
Sal,
say on that, I mean, I think the next leg down on the U.S. interest rates is probably going to be down. The next step will probably be down. So,
Yep.
that's just going to be a little bit worse for the dollar. So I feel like it's a little bit more fuel to the
Right.
international file. There's a valuation on this. I mean, the U.S. is still trading at quite a bit of um, a higher
Discount.
and a premium, if you will,
Yeah.
over on a PE basis relative to at least Europe and sort of the rest of the world as well. So the U.S. stocks are still a little bit more expensive. International, they should benefit from some of these tariff pauses or settling of some of these issues as well, because obviously they have to sell into the U.S. market. So more clarity would be better for international companies, pretty much as for the U.S. companies.
yeah. And Sal, speaking of clarity, you mentioned that Netflix is reporting after the close tonight, but we are really going to start to get into the thick of earnings season. What are you going to be keeping an eye out for? What do you want to hear from management teams during the conference calls in terms of how they're perceiving this environment and how it's impacting the business?
Yeah, there are a couple things I think that are key. Obviously, you always look at earnings, top line revenue, bottom line earnings. But even beyond that, obviously, looking forward, how management's talking about the second half of the year and what their plans are and how they're thinking about ways to mitigate potential uncertainty and volatility from tariffs. And we kind of saw two different answers from that already, right? We saw ASML, which was a little bit hesitant on their forward-looking outlook and couldn't really talk about 2026 growth, and their stock was down 10% after earnings. Then you had Pepsi, who came out this morning talking about how they have things in place that they can help mitigate those effects. And their stock was up about 6% so far today after the earnings. So we want to see what they're talking about looking forward. For me, one of the really big things I want to look at is margins,
Mhm.
right? Nasdaq 100 gross margins are running about 50%. It's the highest it's been, I think, in history. Net margins are about 20%. And so for us, what we want to see is in combination with inflation. So if tariffs stay in place, somebody has to pay for them. Either the consumer is going to pay for them, so we're going to see more inflation, or companies are going to start eating some of those costs. We would see margins start to compress. So I want to see kind of where inflation is, especially on imported goods, and kind of breaking it out which imported goods we're seeing inflation relative to where the margins are, to see how much pricing power they have to push through some of these tariffs if they remain in place. So those are some of the key things I'm going to be looking for
Yeah.
going forward.
Which is challenging for consumer companies, and our economy is so dependent on the consumer because consumer companies tend to have tighter margins than you would see relative
Yeah.
to a tech company, as an example.
For sure. I mean, you look at something like Costco, they run about 2.8 to 2.9% net margins versus, Nvidia, which the margins are significantly higher than that. So yeah, it's a good point. The consumer margins are much thinner here.
All right. And to wrap up here, Chuck, give us some insight into what's happening in the fixed income space.
Yeah, I mean it's tough. They're at the bottom of our asset class rankings have been for really for most of the last 3 years. Yields, they continue to be range bound. That's been most of the case for the last year and a half. Again, kind of what I said with small caps, applies here. They're looking for tariff clarity, so that they can then get Fed clarity. The market is kind of expecting, the Fed funds rate to drop about 50 basis points before the end of the year, and probably a full 150 roughly by the end of 2026. So we're above that neutral interest rate, which is estimated to be around 2.5%. So, it's kind of still restricting the economy, even though GDP is still looking fairly well. But it's going to be interesting to see. One kind of thing that I'm looking at is fixed income volatility. If you look at something like the Merrill Lynch Move Index, it's kind of around where it typically bottoms over the last few years. And so hopefully that isn't prelude to another round of higher volatility, which it just seems to be inevitable over the last 2 or 3 years. It just keeps coming, keeps coming. Just when you think it's going to stop, it doesn't. But I'm hopeful that that won't be the case, but we'll just have to see. Right now, looking at our sub-asset class rankings, we have kind of high yield, international sovereign debt, and U.S. corporates are in the top three. Treasuries, both long and short term, and municipal bonds are at the bottom. And really, looking at that, that hasn't changed a whole lot. High yield has been, at or number one, for a while now. And so, yeah, and they perform very well. They're in the top three best performing groups this year. So another space we're also looking at is convertibles. They've really bounced along with equities as you'd expect off the bottom. I think they're up like 14 or 15% off the equity bottom. And so, yeah, they're quickly moving up our rankings as well.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.